Sars is lagging behind projections required to secure an additional 35 billion rand in revenue. That's according to data from Treasury. The Revenue Service has collected about 39.3 billion rand so far this fiscal year. That's above what's needed to meet the baseline goal of 100 billion rand. But it's below what's needed for collections to stay on course to achieve the higher target that's aimed at easing fiscal pressures. Finance Minister Enoch Godongwana has warned that spending cuts may be unavoidable if revenue fails to meet expectations. More detail is likely to be given when Godongwana presents the nation's medium-term budget policy statement next month. Manufacturing sentiment has improved. The Absa Purchasing Managers Index rose to 52.2 points in September, putting the reading back in expansionary territory and marking the second time this year that the PMI has been above the key 50-point mark. A pickup in local demand drove the improvement as the Business Activity Index and new sales orders jumped. Domestic demand has been crucial as exports have been complicated by steep U.S. tariffs, a challenging trading environment and lingering SA port issues. The positive print for September puts the average reading for the third quarter at 50.8. This is a vast improvement from the mid-40 readings recorded in the first and second quarters. Capitec has reported a 26% rise in half-year headline earnings. That's as it grew its active client base to 25 million. This cements the firm's position as South Africa's largest bank by customer numbers. The group says that the size of its client base has allowed it to reduce its cost per transaction and increase revenue despite being a price leader in the market and investing in new initiatives and products. An interim dividend of 26.20 Rand has been declared. That's a more than 25% jump on the previous period's payout. Orion Minerals has had a difficult year. The aspiring copper miner has posted an annual operating loss of over 15 million Australian dollars. That's more than double the previous year's loss. The weaker results were largely due to exploration expenditure, which it sunk into its Prieska copper zinc mine and Okeep copper project. The group says that the exploration spending didn't qualify to be capitalized according to the firm's internal policies and so was recorded as an expense. And AGOA has expired. The African Growth and Opportunity Act granted more than 1,800 products from 32 African nations duty-free access to the United States. But the deadline to renew the accord has passed, halting a decade-old program aimed at promoting development and democracy on the continent. President Donald Trump's administration has indicated that it supports extending AGOA, but this can only be done by an act of Congress. It's unclear when this could be done, as the U.S. is currently in the grips of a government shutdown. In international news, Total Energies is selling its stakes in several mature oil fields off Norway's coast to Vår Energi as a strategic move to reduce its debt. This deal is expected to close in the fourth quarter of 2025. Let's take a look at this package report for more.
Total Energy has agreed to sell its interests in several mature oil fields off Norway. It's the latest step in a broader divestment strategy aimed at cutting debt. The transaction is expected to close in the fourth quarter of this year, the French oil major said on Wednesday. The company is seeking to focus on more profitable assets in order to reduce its leverage. During Total Energies Investor Day on Monday, Group CEO Patrick Pouyanné said the group intended to raise $3.5 billion through divestitures by the end of the year. That would offset more than $3 billion in acquisitions that have led to a more than doubling of Total Energies' debt in the first 6 months of 2025. The asset is being acquired by Norway's Vår Energi, which will increase its stake in the Ekofisk redevelopment project to 52.3%, Vår said in a statement.
And Nike's first quarter revenue rose 1% to $11.7 billion, beating expectations despite a decline in direct sales. The company's wholesale revenue jumped 7%, driven by strong demand, while its China business faced challenges. Here's more detail.
Nike surprise rise in Q1 revenue and beat profit forecasts. The sportswear brand's turnaround effort has gained traction despite weakness in China and US tariff pressures. Also, the company's wholesale revenues returned to growth and it managed to clear some of its bloated inventory. Signs of progress for CEO Elliott Hill's plan to reinvigorate Nike. He's vowed to refocus the brand around core sports like running, following a string of weak quarters. However, executives warned the recovery was still a way off. Nike expects tariffs to cost about $1.5 billion this year, compared with the previously expected $1 billion. The sportswear brand makes nearly all of its shoes in countries such as Vietnam, that have been hit with steep duties under US President Donald Trump. And China, Nike's third largest market, has been a particular problem. Sales there fell for the fifth straight quarter for the 3 months ending August 31st, as it faces strong competition from domestic brands. Hill admitted Nike still had, quote, work ahead to get all sports, geographies and channels on a similar path.